Welcome to the second webinar of Rosecut. Today I have my co-host Marcus here.
Hi there, how you doing?
Good, how are you, Marcus?
I'm fine, thank you. I'm absolutely fine.
So we have received a lot of interest in asking about, essential investing versus passion investing, and that's why we decided to put this webinar together to answer your questions. First of all, I would welcome the returning attendees from our last webinar. There are quite many of you, and also some my former colleagues at Credit Suisse and Coutts. Welcome as well. And just a bit of background on Marcus, our co-host today. He is the Business Development Director at Cut Wines, a leading wine investment firm. We met a couple of years ago on a very sunny afternoon, enjoying the really nice a bottle of white wine on the terrace in central London. And I totally trusted him on the choice of wine, of course. And it was so nice that I forgot everything he said about wine investing. So I had to repeat my training today, and I hope you guys would enjoy it with me as well.
Thank you very much for having me. Obviously, the wine that we had, I can't remember either. It was so good. But we had a nice evening, nice discussion, and from that, it was really interesting to learn more about Rosecut. Qiaojia is going to give us some more tidbits on that. But on herself, previously at Coutts & Co as co-head of the China desk, and then 4 years at Credit Suisse. So very well versed in what she's going to be telling us about today. So yeah, thank you for having me. It's great to be on and to tell you a bit about what we do. I'm looking forward to hearing about what you guys have got to say as well.
Great. And just a bit of admin before we start. So this webinar will be around 1 hour, 50 minutes. Will be a really lively discussion between Marcus and myself instead of one-way presentation, if you like. So we can draw more comparisons between regulated investment, that is financial investments we do at Rosecut versus unregulated investment. What the pros and cons of each. Please do ask questions along the way. We have our colleagues, David and Patrick, there to answer some of your questions, or nominate your questions for us to answer as we go along. And also, we would really welcome your feedback by the end of this webinar to tell us what you think of it, and any recommendations for the future webinars that we should be running. So today, what we will discuss will be roughly broken down into 3 sections. One is the overarching principle, i.e. the prerequisite knowledge that you should be aware of before you dive into the wonderful world of investing. Second, we would talk about what are the things that people should look at and why they should always have the essential investment into the financial markets, really. And then we would hear from Marcus how they are helping people to do the into the fine wine investing in a very professional way. And then we will have the Q&A session. So before we start, there is a quick risk warning to say anything related to investment expose your capital to risk, and past performance doesn't indicate the future. Also, the currency risk involved in global investing. The first section we would want to talk about is asset allocation. Very common, you can see, commentaries or reviews on newspapers to say someone investing to the certain stocks and made them a lot of money, or someone has built a massive wine portfolio and all that. It's all looking wonderful, but we want to stress that before you dive in, there are certain important principles to understand. So first of all, your net worth is your assets minus your liability. So for example, if you own a property that's worth $1 million and you borrow 600K mortgage on that property, your net worth is 1 million minus 600K mortgage. Your net worth is 400K here. Now, if that's everything you own, your investable assets is actually zero, because after your net worth 400K, if it's just your home, and you ideally would have some emergency cash, but if you don't, then you don't have any investable assets.
Qiaojia,
Why?
sorry, this is really interesting, but I'm interested to know. These things sound really simple when you say your assets and your liabilities, but they, people can have vast assets and vast liabilities. How would you go about putting together all of your assets, all of your liabilities? Is that something that you guys would help with, or is that someone that people have to do on their own?
Great question. So first of all, people obviously typically have more than just their home. And traditionally, people use a notebook or Excel at home to track that. The problem with that is that you may not necessarily know the up-to-date value, or you may not necessarily know where you put certain items. So if you go to a private bank, they will help you to build a personal wealth balance sheet, like at Coutts. But before you receive that report, you probably have to pay anything between £3,000 to £12,000 for advice fee. Rosecut has built that into a platform where you can easily put into the items of your assets into various sections, and we organize it professionally to show you your personal wealth balance sheet. And once we plug in the open banking tools as well, you will see the up-to-date value. So the whole point that we want to put the investable assets here up front is to really let people understand that your home liabilities or emergency fund is not income or gain generating. What will be able to make you more money, simply put, is the investable assets that you have. So everything we are talking about today is the right allocation of things within your investable assets. But before we go there, the starting point is that you need to know your position as how much net worth you have, how much of that is made up of a basket of assets, and how those assets are performing during both good times and bad times. So if people are interested to know more about budgeting than overall sort of wealth balance sheet, I would point you to our website with the link to the last webinar. So this part of figuring out how much assets you have and what you want to do with each piece of that is what we call financial planning. The first thing you need to do is to understand where you are now. And the second is to figure out where you want to go. And this is where typically a financial advisor come in and be useful to ask you the right questions and to get the real answers out of you. And by the way, there's no right or wrong, and there's no the best, the bigger the better, or the richer the better, but to get the right answers that's suitable for you to build your financial plan, and that's like a set lab to guide you to where you want to go. And within the asset allocation on the Rosecut platform, this is where we divide it into 3 baskets. Static is basically your home. Because it doesn't generate any income, you would get some capital gain, but for conservative purposes, we put it as on par with inflation. And the investment basket is basically what your investable assets is about, and how much income and capital gain they will be able to generate for you. And then cash reserve basket is the emergency cash that we would always recommend people to keep, that acts as a buffer to any emergencies. So typically it should be at least 3 months of your monthly spending. And
Qiaojia, back on that slide that you were just on, are people able to edit that in real time? So for example, if I was to buy a property, or if I was to do something that changed that, I could literally go online and change it myself, or would I have to go through you guys?
So basically, you would create your Rosecut profile, and within the profile, you have all the tools to change, where you are and what happened in your life recently. For example, if you have recently bought a new property, then you can input that into the platform, and it will quickly adjust your personal wealth balance sheet for you. So this is much easier than giving your private banker a call. Sorry, guys, and ask the assistant to put into the system and generate paper-based wealth balance sheet and to show you. This can be done at midnight with your excitement of buying a new property. Or, same thing happens to any other big event in your life, having a new job, having a new baby, like my co-founder, and, any major life event. It really should be reflected in your personal wealth balance sheet timely and accurately. Moving on to the classic asset allocation. So once you have made it, such as selling your business or getting a massive bonus, or getting a big inheritance, you would talk to some private banking specialist, and this is what typically they would talk to you through of how to look after that pot of money. There is a good reason why you should have a asset allocation that we will, walk you through. But basically, this is how typically it's laid out. 5% go to cash or cash equivalent. Cash equivalent is short-term fixed income, bonds, government bonds and such. And then fixed income, including both government bonds and corporate bonds. Essentially, it is you lending money to the government or the corporate, they pay you an interest rate that is typically higher than the term deposit rate, but involves the risk that you cannot get the money you lend to them back. And the equities is what people are excited about because you own a slice of share of a company that you either believe in or like or want to support. And then alternatives is a wonderful and complex world. Most of the asset classes, most of the assets in this asset class are unregulated. So for example, if you want to buy a buy-to-let property, you can do it yourself. You don't need, regulated advice to buy a buy-to-let property. Or if you want to dive in oil or gold, or you want to buy fine wine, this will be the focus of our discussion later, or jewelry or arts, private equity funds, VC fund, even cryptocurrencies. So for this section, right, it's quite complex to navigate through, and but it's what excites people, and that's why a lot of them is called passion investing. There is a Coutts Passion Index that tracks the return of the major passion in investing products, and the long-term average return is about 5%. But within each category, like jewelry versus wine, the performance, the return is very different. And this is my first point here, is that because this is unregulated investment, it actually stresses a bit more about how you should rely on the experts in each field to make the right decisions, because there's no FCA at the back to protect you if things goes wrong.
And on that slide, Qiaojia, I was just looking at your the 20%. This is a completely interesting question for me because I ask this of a lot of bankers that I deal with. What split, that 20%, how would you then split that amongst the rest, amongst real estate, commodities, wine? Would you have an equal split amongst all the points you've mentioned, or would you leave it up to the individual investor based on their knowledge of each area or their interests, for example?
Very good and technical question. So I think it's a combination of a few things. One is that what you really know and good at, so for example, some people are passionate about buying properties and doing it up. That's their passion to an extent, and they have they have deep knowledge of London's real estate market, and that's what they can do. Same thing goes with people, who are wine connoisseurs and really understand. And I know there are quite a few here today. So, they can dive into the different wine regions and understand which producers and the pricing. So that's what we do. They can do. I would say personally, I don't think that people have to equally split their 20% allocation into all of this. They are free to just pick one or two types in this section. But what they should care about is the so-called, counterparty risk, or, every single investment risk. So if you're going to invest into real estate and put all your money into a single house, that may not be the most prudent thing to do. And the same thing with the wines. You'd rather have a portfolio of different winemakers rather than betting on a single one. For the bigger family offices, who have maybe, 10, 20 million to deploy into each asset class, they wouldn't put 10 million into a single private equity fund. They probably will slice it down to 2 to 3 private equity funds just to compare the performance and have diversification. Diversification is really important for this asset class, and we will be talking a bit more going forward. So here's a passion asset picture. So you can see visually what kind of things that is involved. And I would like to point out that the diamond at the left corner is a Rosecut diamond. That's why I picked this picture out of Marcus' presentation and to put it here. And continue with classic asset allocation. So this is where I would say, the typical suggestion from private banks is that you should have 80% of your assets in liquid asset classes and 20% in illiquid. So that includes all the illiquid stuff. However, my personal view is that this is not a fixed percentage. Which means that, if your alternative asset class has become 21%, then, oh my God, you have to sell the 1% to bring it back to balance. I don't think it should be followed too literally. But this general guidance is very important. And I think the bottom line is your liquid allocation should always be higher than your illiquid allocation. Especially your illiquid stuff might contain leverage, such as your buy-to-let with a mortgage, so you could avoid liquidity squeeze during bad times, which is possibly now. If you're out of cash and out of job and have to pay for your living expenses, but you only have buy-to-let properties under your name, you might have to sell one of them to sustain yourself. And while now it could potentially be a bad time of selling your property, but you have to sell it to meet the short-term cash obligations, then you can have a fire sale that has a massive discount on normal value of your assets. So I think the key point here is to make sure that you get the liquid versus illiquid balance right, and Rosecut platform will show you exactly that. So there are a couple of other important notes. One is that, it's actually quite difficult to understand which investments are in terms of seeing through their layers of structures and stuff like that. So REITs, which is Real Estate Investment Trust, is a really good example of how it's listed on the stock exchange and traded like equities, but the underlying investment is actually typically commercial or industrial real estate assets. So in this case, there's always debate about where you should put rates, but I'm leaning towards you should see through the structure and consider it as more illiquid assets, which has proven during the current corona crisis, the price of rates has dropped so much because investors saw it as a long-term illiquid assets that has been negatively impacted by the corona situation. Second point is that for you to have meaningful diversification. The point of having diversification, as just briefly mentioned, is to have different asset class in your overall investable assets basket and make sure that they sort of hedge the risk against each other. There's really complex sort of mathematical models that you can use for this, but the general thing is that if you think that put all your spare cash into 3 buy-to-let properties in London is diversification, then it's not really, because all of these 3 buy-to-lets are tied to the UK economy, tied to the immigration trend or demographics trend of London. And if the whole London market goes down, all of them goes down. In this case, if you have investment into the stock market in the US and investment into the fine wines produced in France, it would be more meaningful than having just real estate assets. By the way, that's all illiquid as well. For the tech entrepreneurs and all other entrepreneurs present at our webinar, the last point on the important notes is that when we look at your investable assets, we typically exclude your company ownership. And it's particularly important for you to keep your investable assets liquid, because your company ownership usually contributes as a lion's share of your net worth, measured by the company valuation and your ownership percentage of that. And because it is highly risky, because it's a single company risk and subject to a lot of tailwinds in the external environment, and also typically illiquid, which means you can't sell it for cash tomorrow. So therefore, your investment, your investable assets should really act as a diversifier and should be staying as liquid as possible to balance out your overall risk in your net worth. So from the wealth management perspective, we consider your company ownership is as a private equity alike allocation.
Would you say there's such a thing as too much diversification, or would you say you can never have enough? The more that you diversify, the better?
I think the point about diversification is that it needs to be meaningful. So you can buy into active funds that charges you 1%, but holds 400 stocks listed in London Stock Exchange. In that case, it's quite diversified, but it doesn't deliver you, or most likely won't deliver a superior return to you. You are better off maybe just buy two trackers, FTSE 100 and FTSE 250, and with much cheaper fee. So that's diversification, but less meaningful. But if you split that money to put, into the FTSE 100 and FTSE 250 trackers, and then put 10% into either fine wine or put into a VC fund in the US, then that would be a meaningful diversification. Typically, though, as your wealth grow, you probably require more diversification, sometimes bespoke to your personal circumstances. In general, if you're a working professional that owns, your home and financial assets, you require actually less diversification, or sort of constraint. You have less constraint in your diversification compared to a tech entrepreneur. I think one really common mistake here is people tend to buy what they know. And when you buy too much of what you know, that's the concentration risk. So for example, Marcus, you are a wine expert. If you put all the cash you have into wine, then we would say that's a concentration risk, even if it's diversified between 100 winemakers, for example. For myself, when I was working as a banking professional, I never buy equities or bonds of banking companies, banks, because that's a concentration risk of both my assets and my income. My income rely on those banks. And now I'm a tech entrepreneur, and I cut down my tech allocation in my financial assets. So these are the things that to keep in mind. But of course, if people have questions around this, then we can go into that later. Second part, essential investments, why you should always have it. So again, essential investment, we define it as investment into financial market. So first of all, it really outruns inflation for most of the years for the past 100 years. People think investing is dangerous because you might lose money, you might make money. The point I would make to you is that if you don't invest, you are most surely, definitely losing money slowly every year, depending on the inflation rate, anything between 2 to 5%, or even double digit a couple of decades ago in the UK. And second point is that you should be earning your retirement. Retirement is relatively a new thing, and it should not be taken for granted, even if you are paying your national insurance, because you are not mostly be happy with £140 a month once you retire, right? So if you want a better life, you need to earn it. And by saving part of your income today and invest it consistently until the moment you retire. Even 100 years ago, just 100 years ago, the Coutts bankers are considered having a great job, working at the office instead of the factories. They still had to come into work until the time they dropped dead on the desk. There's no retirement whatsoever. So, for this, we need to think about really rigorously putting aside of our savings every month to pay the future you, really. So the third point is that we would say typically financial investments make more than other investments, such as alternatives. People would challenge to say, oh, what about private equity funds? You can make 15% per year, roughly. Correct. That could be potentially higher than financial markets, which deliver on average 7% on a long term, past how many decades. However, because of the illiquid assets have a higher barrier and also the illiquid nature of that, so that is actually what we call a risk premium, which needs to be compensated by the higher return. Now, typically real estate or other type of alternatives doesn't deliver 7% a year. Last point is really important is the power of compounding. And this is what financial investments can help you while most of others don't. So compounding, a simple rule is a 72 rule that if you want to double your money, 72 divided by the annual return. If it's 7%, it takes 10 years to double it. So if you invest 100K today with Rosecut, after 10 years, it becomes 200K. After another 10 years, it becomes 400K. Whereas typically other investments are linear return, which doesn't get you that kind of accelerated growth of your asset value. So that comes to the proposition of Rosecut, and this is what we think we can help you with, is that we deliver a private banking quality investment management service, and we offer regulated advice and help and guide you through the whole process based on your personal circumstances. The Rosecut Investment Committee is made of myself, Daniel, and Mike. Daniel, in short, was an Barclays Private Bank portfolio manager and has done all sorts of other wonderful things of building very nice investment portfolios. Mike was the former global chief investment officer, not chief information officer, investment officer at Credit Suisse, one of the biggest private banks. So three of us have built a differentiated investment product that gives you much more downside protection during volatile times like now. So here is just a quick view of our strategic allocation, the investment process, how we go through the strategic asset allocation and tactical allocation and construct the portfolio. This approach, frankly, is not that different from the private banks, because that's just that's just the most systematic way of doing that. What is different, though, is in our strategic asset allocation and tactical allocation. When you give your money to a private bank to manage, typically they have a very constrained allocation into different asset classes, like what we were talking about before, fixed income versus equities, for example, between 35 to 45%. What does it mean is that your portfolio manager have very little room to maneuver when the market is going through a downturn. So, you will literally see your portfolio trending down with the wider market. It's good for you if it's, it's good for you financially if you can hold on to that and really just ride out the bump, because over a long term, as we said, investment, return should be good and should be beating the inflation with extra bits. However, in the short term, it's really painful to watch. So some people cannot, sustain that, and they get the pressure and come out at the wrong time. So what Rosecut does is that we have a so-called agile capital, which is a cash style that can be turned at 0% to up to 25%. The portfolio manager is allowed to hold up to 25% if they see fit. So which means that when we see the market trending down, we can take money out of the portfolio and to basically show you that your money trending down less than the wider market and give you more confidence to stay in for the long-term benefit. So here comes our performance. The portfolio was started last May with the first client went into the market, and year to date, despite the massive downfall in the wider market, we have been positive, and since inception, we delivered 5% against the ARK Sterling Balanced benchmark. And this is another thing I would quickly point out, is that people need to compare apple to apple because it's the same sort of risk level you should be comparing the performance on. And historical volatility and drawdowns. The drawdowns, I think maximum drawdowns is a really good way to measure the risk, as that's the value difference between the peak and the trough. So, you can see that with our cash style, we can actually control our monthly maximum drawdown much better than the wider market and slightly better than the benchmark. So here, I think with just another emphasis on the difference between regulated investment and unregulated investment is that with regulated investment, you have FCA on our back and taking our advice and our conduct to make sure it meets the standard, whereas unregulated investment, FCA doesn't provide any guidance or supervision in that. But that's where the excitement is. So now let's move on to the wonderful world of wine investing.
Thank you, Qiaojia. Thank you for that. So I'm going to talk a little bit today about the fine wine investment market, the pitfalls, the pleasure and the profit of the market. Ordinarily, I'd like to be doing this over a glass of wine, but the world is a bit weird at the moment. So I'm going to invite you all cordially to our office for a glass of wine when this is all over. So yeah, if you enjoy this, please let me know and we can have a face-to-face in the future. So we're a fine wine investment company. We build investment grade portfolios of physical fine wines for high net worth investors. We're not a fund. We look after 130 million in terms of AUM for investors in 75 countries worldwide. And all of our investors have their own bespoke portfolios built to their specifications and their needs on risk profile, target returns, timescales, and investment level. In terms of returns, we've achieved a compounded annual growth rate of just under 8% since 2009. And in terms of worldwide scope and offices, we've expanded from London to Hong Kong in 2016, Singapore in 2018, Shanghai in 2019, and New York was supposed to complete the set this year. I was supposed to be in June for all of our launch parties, but unfortunately that's been delayed. So New York is probably going to be Q4 of this year or Q1 of next year. So the company, how did it start? How do we get into wine? Why are we here? So Philip Gearing on the right, our chairman, he was a banker, a successful banker in the 80s and 90s. And I'm sure he won't mind me saying that he used to say to me his favourite times at the office were the long lunches with clients and the nice bottles of wine, which I suppose is a little bit different at the moment. So his passion from wine really stemmed there. And he spent a lot of time travelling to the wine regions of France, Bordeaux, Burgundy in particular, collecting wine. And he brought his kids along for the ride. You can see Thomas Gearing there on the left, our managing director, and they're in a very famous parcel of land, Romani Conti, which a few of you may know. Last year got the auction, the highest ever bottle of wine sold at auction, the 1945 DRC, for over $560,000. So quite a lot. But yeah, Philip's background in wine began there. He set up a Burgundy merchant as a passion project in the early 90s. And he set up a price comparison company for fine wine in the mid-90s, all on the side. I think they call them these days side hustles. But anyway, Thomas and Oliver, his sons, grew up around wine. And then on the next slide, you see Thomas there today. He runs our business as our managing director, and Philip looking a little bit wiser, I'd say, as our chairman. So why do we do this? So we invest in this asset class for a number of reasons. Number one, it's a tangible asset. You know, Qiaojia, you mentioned property a couple of times before. A lot of people enjoy investing in property and invest in property because of the security it offers. You're buying a tangible physical asset. I'm not going to say to you that that case of wine that you own in bond is going to make you money every year. In fact, it probably won't. But over the long term, you know that you have a physical case of wine under your ownership and control sitting in bond, and it's a tangible asset that you can see, touch and feel, which a lot of people like to have in their portfolio. Fine wine provides stable growth, and we'll talk a little bit more about that in the next couple of slides. We don't see, wild swings like we do in some other markets in fine wine because it's based on supply and demand rather than based on general financial motivators. Diversification is key. That's literally what we're here for. Okay, we're not flying around the world saying to people, sell everything you've got, sell your houses, sell your funds, sell your equity, sell your fixed income, and buy fine wine. It's going to be the best level of return. We are not saying that. As Qiaojia said, we're talking about a small part of a high net worth investor's portfolio. And within that part of the portfolio, they are diversifying into assets like this, which provide true correlation. So that's what we're there for. As I said before, our long-term returns are 7-8%. And that's what we're trying to achieve for a balanced client. 7-8% net per annum in a safe part of your portfolio. Wealth preservation, tied to that over the long period of time, this is an inflation-beating asset class. It's tax efficient, and I need to qualify this by saying that we are not tax advisors, but in the UK, in Europe, in Asia, generally fine wine is considered a wasting chattel in UK law, which means it doesn't have a shelf life of over 50 years, and thus it's capital gains tax exempt, which is a key benefit when looking at this asset. But you need to be careful because there are different rules in different places. E.g. in the US, there is a collectibles tax that you have to pay. And again, lifestyle elements, this is a passion asset. As you said, as you mentioned earlier, passion assets like art, classic cars, wine, diamonds, people buy them because they enjoy being involved in them. I mean, 80% of our investors are pure investors, but we have got a lot of people that are interested in wine as well. So what are the dynamics? What makes this market go up or down in value? There's a number of things. Geography. So you can only create this wonderful wine that we buy in certain locations in the world. The way that the soil interacts with the air coming off the sea and the sun and the terroir, you can only produce these in a certain area. And that's very, very unique. Where I'm sitting right now, you can't produce wonderful wine. If you could, there'd probably be a vineyard here. Okay. And on top of that, we're only buying into maybe 1% of the world's wines that get produced, the top wines. And there are regulations surrounding how much producers in those regions are allowed to produce. There's the AOC regulations in France, there's the DOCG regulations in Italy, which stipulate the growers can only produce a certain amount of hectolitres of wine per hectare of land. Okay, so we've got an amount of wine created each year, which is effectively finite. And when that's bottled, you can't go back in time and produce any more Margaux 2000 now. So what you have is quite unique in investments in the fact that this wine every year is getting consumed. Okay, so in investments, you can't really guarantee anything. I'd never say to someone, I guarantee it's going to make you 5% next year. But I think most people would say it's fair to guarantee next year there will be less Mouton Rothschild 2005 available than there is this year, primarily because people are consuming it. And that's what's pushing the price up. Okay. Then you add, on the other side of the coin, global wealth all over the world is ever increasing. Burgeoning middle classes in countries that are up and coming. You've got places like India, South America, which are starting to drink more and more wine as they become wealthier as a nation. So what that increases is global demand for these assets. So you've got global demand increasing for a particular asset, but you can't create any more of that asset to satisfy that demand. And then on top of that, these wines are getting better in bottle and getting more desirable, so people are drinking them. And that pushes the price up, and that's what moves the market, not really general market factors that you'd see in equities.
How much demand do you see from Asia markets from this? Because as this general aspiration to the lifestyle and appreciate finer things in life, do you see them more focused on drinking different wines, buying it for drinking, despite it's more expensive and investment grade, or do you see them really into the investment return part?
Yeah, so I mean, Asia is a massive story for fine wine over the last 20 years. China. Everyone says, China, they've been there, they've done that, they're out of the market. But actually, China are the biggest consumer of red wine in the world as a nation. But per capita, they're not even in the top 50. The Italians love them. They drink a litre of wine per week per person.
So,
In China, it's like a glass a year. So there's a long way to go in those regions. And yes, they're buying the wines. They're buying wines for consumption. They're buying wines for investment. Their tastes are growing. They're interested in Burgundy and Rhone, not just Bordeaux. But yeah, I mean, certainly China, Asia is linked to the fine wine market just because there's a huge amount of people and a lot of wealth that are buying into these asset classes. And there's other regions of the world that won't be big wine drinkers because of things like religion and culture. Whereas over there, consuming wine and consuming alcohol is kind of like the West. It's not a big deal. So this is just a quick snapshot looking at fine wine versus major indices over the last 17 years. So this gives you a nice graphic of how wines performed over the long time. You see that big, thick red line running through the middle. That's the LiveX Fine Wine 1000. LiveX is the London International Vintners Exchange. It's a bid-offer spread matching platform for fine wine, but it also provides data and indices, and we use it primarily for that. So we'll get all of our prices from LiveX. We don't price any of our wines from LiveX. We'll compare ourselves to the indices that come from LiveX. But looking at the graph, you can see quite clearly that in the long term, fine wines perform very, very admirably, just below gold. So again, adding something to your portfolio such as this is not a bad idea. Fine wine versus other alternatives, you can see here, this is just another graphic representation with the volatility added in. Fine wine has a low volatility. So it's quite a boring asset, really, in the sense it doesn't move too much and doesn't spike too much. I suppose this would be the most important slide I would suggest when I'm trying to explain to an investor why they would get into this particular market. Because 2008 financial crisis, as we know, markets crumbled all over the world. Fine wine, as measured by the LiveX 1000, was down 1%. In 2017, you've got a lot of booming economies. Oil did very well. You can see the MSCI, S&P, all did very, very well and were very attractive. And fine wine did very well as well, 10%, not a bad return. But nowhere near as well as these other areas. And again, as I said, we're not trying to say that we would beat all these other markets every single year. What we're suggesting is for a 5% or a 10% section of someone's portfolio, having an asset which gains 7, 8, 9, 10% in a good year and doesn't lose you anything in a bad year is very sensible. Because remember, if you lose 30%, it's going to take you a lot more than 30% to get back to where you were before.
Yeah, I think this page actually really shows the power of diversification of one's portfolio, because what we look at from a financial advisor's point of view is the correlation between each piece of your assets, right? So if the equity goes down together with real estate, then you have all of a sudden two pieces of your assets losing value in a bad year, whereas your wine will hold value at the moment. So even if it's, so I think that's a really important message. Not every piece of your investment needs to deliver the highest possible return across the board, right? Like you need some of them just to hedge the risk and act as a buffer at certain times.
And this is, I suppose, a visual representation of my saying that the fine wine market is incredibly boring. Again, you can see the last 6 months, fine wine has ticked down ever so slightly, hasn't really budged. And the COVID situation has had a huge effect on the financial markets. And in most cases, those rallies that have been coming to us recently have pushed us back into positive territory, which is fantastic. But that's not necessarily, that yo-yo effect is not necessarily what you want for your whole portfolio. So again, this shows you wine being incredibly boring and sitting in a sensible section of your portfolio. This is obviously very, very important. I mean, there are a number of reasons why wine is a great investment, and there are also a number of reasons why you should be very careful when investing in things like this asset. It's not, excuse the pun, the most liquid asset. It takes us, as a professional outfit, 6 to 12 weeks on average to liquidate a typical portfolio to get the best possible market price. You would never invest in this market thinking that you can sell your wine in a week's time for the same price. It doesn't quite work like that. It's like saying you're going to buy a house, and if you need the cash back in 2 weeks, you can just sell it again. It doesn't work like that. You need to understand that 6 to 12 weeks is the average liquidation time for us to get the best possible market price. But that being said, as members of LiveX, members of the Fine Wine Exchange, we can sell on the exchange. You would have to put an offer out that was under market, and obviously you would obviously lose money there. So it makes sense to understand liquidity periods are longer in this asset. Market trends, this is still a luxury good, okay? This is still something which becomes popular in different parts of the world for different reasons. Famously, Chateau was was on Casino Royale, the Bond film. He was having a nice glass of Angelus on the train in a lovely tux, and the price of Angelus went up. And then, it comes back down again when people realize that it's just a film. The wine hasn't changed, and James Bond's a fictional character. So you need to be aware of these sorts of trends. And as a investment company, that's part of what we do, is looking for the trends, buying into them at a sensible point, and obviously buying out at a sensible point. So that's where we add value. Counterfeits. You may have heard of the famous story of Rudy Kurniawan, a very famous wine forger. He's sitting away in an American jail. I do think that when he comes out, he's got such an interesting story. You can see it on Netflix. He's got such an interesting story. I think he's going to come out and he's going to be like the Wolf of Wall Street. He's going to be doing all sorts of presentations and speeches. But either way, it's a famous story. I'd have a look if you can. But you need to understand that wine, art, cars, in some cases, these can be counterfeit. It's very hard to counterfeit an equity, but it's a lot easier to counterfeit a bottle of wine. So you need to be very careful. If you went to, if a client called us up and said, I'm going to an auction, I've seen a 1970s Burgundy that I quite like, I'm going to buy it. We'd say be very, very careful and understand exactly where that wine's come from. Look at the history, check the provenance. You need to be sure that this wine is genuine. We don't have to worry so much because we're only buying wine that is in the bonded warehouse system. So we buy wine directly from the négociant, who buy from the producers, so we can see exactly where the wines come from, and it goes straight into our bonded warehousing facility, which is handled by experts with expert care and attention. And you can see exactly where that wine has come from, where it's been. So we don't deal in wine past the last 20 years in most cases. So, we're very, very careful. And again, that's why you would use a company like us with 130 million under management, because you can ensure that you're getting access to provenance stock. And as Qiaojia mentioned, it's an unregulated market. Unregulated isn't a bad thing. There's flexibility. There's different ways of owning these wines in companies and trusts, and it gives a little bit more flexibility. But on that regard, you need to understand, if you lose money in fine wine, you're not going to get money back from an ombudsman in any part of the world. And again, having unregulated assets in a portfolio for a small part is sensible, but again, don't put 70% of your money into unregulated markets.
That's a great reminder. And I was going to say that, Marcus, we heard all these things in the Chinese market, saying that the Chinese market consume more Burgundy wines than ever was produced in Burgundy. Is it true?
Yeah, there's a rumor that there's more Burgundy wine for sale in China than Burgundy have ever been able to produce. So that would give you a reasoning to double check the bottle when you see it. And I've seen some fantastic fakes, actually, quite funny ones. For example, a white wine from a company from a producer that doesn't produce white wine. So that's your first clue. So En Primeur, so this is something that we do also, which is when you're buying wine when it's effectively still in barrel in Bordeaux. This can be in Burgundy and other regions of the world, but Bordeaux most prominently use En Primeur, which is when you're buying a futures contract. So you're buying wine when it sits in the barrel, and your wine sits there for delivery in 12 to 24 months. Usually it takes 2 years for delivery. And that's often the best time to buy wine as an investment, because you're taking some risks as an investor. You don't quite know how good the wine's going to be. It's not bottled, so you haven't got access to it. You're taking counterparty risk with the producer. So in most cases, that's the best possible opportunity to buy wine, the best price to buy wine. So it's a big part of what we do. Records for wine futures and buying in this way go back hundreds and hundreds of years. But the last 50 years post-war is when it really kicked off. And it really was a way for producers to cash flow their business. But it's moved on. It's moved on now. If you go to the next slide.
Before we move on, I just want to point out one thing, is that, the wine futures is a descriptive way, but the misnomer in the financial terms. I've got a few questions before. So it doesn't mean, there's leveraging effect here, in the financial assets. It just basically simply might mean buying ahead of time, like you're buying an off-plan property, that, you secure it ahead of 100% the final output.
Absolutely. And I've got on there wine futures, and I should have just done that, wine futures. So that's what it is.
Yeah.
But anyway, so the 2019 campaign, and just to know what the numbers mean, 2019 vintage is the year that the grapes were grown, picked, the vinification procedure began, and that's when they got put into barrels. So that's the year that the wine began its life effectively. It's still the 2019 vintage in Bordeaux. They're sitting in barrel And what usually happens in April, the wine trade descends upon Bordeaux. There's loads of pomp and ceremony. It's a fantastic time to go and taste the wines. But the most important part of that is the critics, the key critics tasting the wines and providing their scores. And they provide barrel scores. And it's an indication of how good they think the wine will be. It gets another score when it's bottled as well. But once you have those scores, the producers then price their future contracts and they sell them onto the market. Okay, but this year the campaign was delayed, first time since World War II because of coronavirus. We didn't know if there was even going to be a campaign, if they were going to postpone it until next year, how it was going to work. But eventually it kicked off, and what we saw was a really interesting opportunity for investors in fine wine, because the general wider market malaise, because of what's been going on. They decided that they can't really release these wines at really high prices, okay, because of the wider community is more concerned about the pandemic, more concerned about the general health of the economy, rather than buying more wine. So I suppose as a concession to the wine market, the key producers released at around 15 to 35% discount from the 2018 En Primeur vintage release, which is an exceptional discount to last year. And bearing in mind, 2019 is a very, very good vintage. It's one of the top vintages of the last 10 years. So that's an opportunity that we haven't seen really since 2008. The 2008 vintage, which was released in 2009, again had massive discounts to the previous year because of what was going on in the global financial crisis. And again, that's been an exceptional investment vintage over the last few years. And this is Mouton Rothschild 2019. This again is a graph, and as an investment company, this is what we do all day, every day. This is looking at all the wines with 95 points and above, and their market prices. And you can see the 2019 with a 98 to 100 point barrel score. If this gets 100 points on bottling, then you're effectively saying this is going to be one of the best wines from the last 20 years, and it's also the cheapest, which makes it a fairly easy buy for us.
So question here, Marcus, do you think people who are new to wine investing should basically consider this a better year to enter the market, or do you think they are subject to more volatility, like typically in the financial market if you're getting in a recession year? Yeah,
so we as a company, it depends on the risk profile of the client. We as a company build the portfolio to their risk profile. So if a low risk, if someone came along and said to us today, I want to invest £200,000, I'm low risk, I'm looking at 7 to 10 years, then maybe they wouldn't have very much En Primeur, because it is a slightly risky way of investing. Usually, I mean, I wouldn't say this year is risky because of the disparity in prices, but usually En Primeur can be a little bit risky. If someone comes along and says I'm medium risk, I'm looking for a better return, then they would have a higher percentage of En Primeur wine in their portfolio. In terms of investing this year, I mean, at the end of the day, if you buy in this year and you're looking at investing now, you perhaps, in a medium risk investor, have 25, 30% of your portfolio in 2019's, which is a great investment year. So it would be a sensible opportunity. We've also seen the fine wine market in general come down over the last year or so, primarily because the key wine consuming nations, places like the US, China, and the UK, have all had their individual issues. In the UK, you've had the ongoing Brexit malaise. China and the US interlinked with their ongoing trade disputes. Hong Kong protests, the new law in China and Hong Kong, the Trump tariffs, charging 25% extra for French wines to come into the US. Funnily, all the 2019s are generally above 14% because those tariffs only come in on wines under 14%. So I think that was interesting for the French to make their wines a little bit stronger this year. But either way, those few key things have brought the wine market down, and that's not going to last forever. So I'd say it's a sensible opportunity to get into it now. So what do we do? I know that we've got only a few minutes left, so I'll wrap this up. So we build, as you know, bespoke portfolios of physical fine wine, but we do everything for the client from the end-to-end service. It's like giving money to a wealth manager. They do everything from start to finish. We order and receive the assets. We monitor the portfolio. We store the assets. We manage the account. And that's what I mean by that is this isn't, right, we're going to build you a wine portfolio. We're going to put it in a fantastic location that's temperature controlled, humidity controlled. We're going to throw away the key and give us a call in 5 years and see how it is. We're constantly looking to potentially sell wines where we may think they've made a great return over the last 2 years and it's worth selling those wines, taking that return and buying into something else. We obviously provide full brokerage at sale. So we have a trade sales part of our business, which works with brokers and merchants and wholesalers worldwide. And that's how we sell our clients out of the market. And then obviously repatriate funds back to the client's account when they're finished with their investment. So that's a bit about what we do. Okay, and this is our investment criteria. Now, this one's interesting because when people are new to fine wine or new to fine wine investment, they always ask me the same question, which is, I had a great bottle of wine. Do you invest in this wine? And the answer is usually maybe, maybe not, depends on the wine. But they might say, oh, you don't invest much in Argentina. Why is that? And the answer is because these wines they've got to tick all of our investment criteria. It's very difficult to tick all of these boxes. Let's say wine in question has got a great brand. It's very well respected in the wine industry. It's got a brilliant producer, great history. It's been around for a long period of time. The particular quality of this vintage is fantastic. The critics are going to get a good score. But liquidity, let's say we don't see an avenue to sell that wine in 3 to 5 to 7 years' time. We don't see a secondary market, then it's not a buy for us. Then you're just punting on a potential wine, and that's not what we're about. We're here to actually build a return over the long term by looking at wines that have got long-term trends and all those kind of things. So these are the criteria that we would look at.
So I was going to say this, we can really draw the, parallel comparison to investment into financial market. Typically, if we look into fixed income, we would want to go after, the investment grade, anything below, we treat it with great caution. So that doesn't sound like I can, go to the supermarket and buy a 10 bottle wine and ask you, Marcus, if this is good enough, right?
Exactly. So our decision-making process, you probably think that we snapped this slide off Rosecut, but I promise we didn't. It's very similar. We're an investment company, so we do the same thing, just from a wine market angle. So we plug in the wine market analysis with a macro view. We then have a long-term market outlook, which our investment committee considers, and we then strategically allocate a portfolio for the client, adding in their risk, their return objectives, their risk profile, etc. Over time, we're tactically allocating those wines, as I've said, buying and selling, performance review. So we're consistently looking at the performance of those wines. And, it may be a case that in 2 or 3 years, wines that we've bought haven't done very well. And we may say, look, ordinarily, if you just bought a collection of wines through a merchant, you'd be sitting on those wines and they wouldn't be doing very well. But through us as an investment company, we're going to sell those wines because we didn't make a right call, and we're going to use that money to buy in somewhere else. And then we're constantly, researching and analysing the market and adding in our current views, and that makes up our portfolio management. This is our long-term market view. So there's always a question on where do you invest? Well, this is where we invest. 40% Bordeaux, 30% Burgundy, 10% Champagne. You can see, so quite heavily focused on France. But you have got Italy, the US, and other, which would include places like Chile, Argentina, Australia in there. But that would generally be our view. If someone came to us today and said, I want to invest £500,000 in fine wine, this would be the sort of allocation that we would look at for them. This is our performance versus the market. Again, I'm sure we'll be able to send these slides out so we can flip through these because I don't want to waste too much time, but you can see we've outperformed. And our volatility has certainly been lower than the S&P, and it's been pretty much in line with the LiveX 1000. So how do we store and how do the clients own the wine? They own original wooden casing stock. So wine is all in its original, it's an original wooden casing, and you own the full title of ownership. So that is the key benefit of this for investors. They need to understand that their wine is sitting there under their ownership, their control. We manage it for them as an investment, but they own that. So that provides all the security that they need, knowing that case of wine, if they really wanted to, they can go and pick up that case and take it home with them. That storage facility is operated by London City Bond, and that's obviously, comprehensive insurance cover, 24-hour monitoring. There's 3 full-time cult wine staff there. It's obviously humidity and temperature controlled at all times. So it's a fantastic facility to store wine. And we've got 130 million there now, and we've got capacity to go to about 500 million. The only problem with that facility is legally, as it's in government bond, you're not allowed to open wine in there. So we can't go and drink wine in the facility.
Oh, no.
Quite nice, but there you go.
I think we've just answered one of the questions. Chen Hu asked, do you actually own the physical wine or the paper wine? There's no paper wine like the paper gold. So you actually own those bottles sitting in the storage, but you can't drink it, sorry.
Yeah, exactly. So the way of owning a wine fund, you would own a percentage of X number of cases of wine. That would probably be determined as paper wine. But in our way that we invest, our clients own the physical asset. we're not quite as technologically savvy as Rosecut, but you can manage your portfolio online. That's how everything's done, through online or through an app. You can see everything on there. You can see your P&L, you can see all of your graphs, you can see your stock records, your sold stock. Everything is through that facility, so clients can get in contact with us on buys and sells on there as well. So it's very, very easy to use. And yeah, here we are. So we've got a particular interesting offer for Rosecut staff. So sorry, not Rosecut staff, Rosecut investors. So usually our minimum investment is 25,000 sterling. But also with some companies, we offer managed accounts. So when a company can invest on behalf of their clients with us, and that provides a couple of key benefits. So through Rosecut, ordinarily, if you're investing directly with us, you'd need to invest 25K. You get an exposure to a wider portfolio of wines because this is a managed account. So you invest in a mini fund and you get access with your £5,000 to, let's say, £500,000 worth of wines. You also access higher tier fee models. So in our fees, the more one invests, the less the fees are. So therefore, again, if normally you invest 25,000 as a starting level investment, you pay a higher fee than someone investing $1 million. In this way of doing it as a managed account, you get access to the better fees, providing that the total fund level is above those tiers.
I think this is where we would jump in to say, if people are interested in this and with the full knowledge of the unregulated nature and the alternative asset class nature, i.e. the illiquid nature of the investment, then you can look at your Rosecut personal wealth balance sheet to see how much percentage of that is suitable for this, and then we can, introduce you to Cotwine for discussion starting from here. So I think that's the end of our talk. I think I would just like to conclude to say that it's not an either or situation. You don't have to choose between investing to financial markets and fine wines. In fact, if you want to be really smart about this, having the right diversification and risk management, you can do both with a thoughtful allocation like we discussed. So ask us anything, any question that you guys have.
So I've actually got a couple of questions here that I'll happily answer. One has come through to me that says, can I invest through a company? And the answer is absolutely yes. The flexibility in this market is very strong. You can invest through companies, through trusts, through different structures. At the end of the day, you're buying a case of wine. Obviously, we're buying it for its investment merit, but that's the beauty of this asset class, is the flexibility. For example, we're partners with Bank of China, and they've set up a Union Pay facility for us in China. So our Chinese mainland clients can pay via China Union Pay, for example. So CUP, you can pay through mainland China. So there's a lot of flexibility of doing this through companies, trusts, different structures. Should we answer one question per person?
Sure. I think it will be good if you can just pick up certain questions that you want to answer.
Yeah. There's another one. How often is wine traded in the client portfolio? Again, good question. It depends on the client's risk profile and their target returns. So it may be the case that there's certain portfolios that we wouldn't touch for a year or two, and we're allowing the wine to obviously appreciate, and then we may sell if there is a need to do so, if we've made a mistake, for example. Some cases, well, not cases of wine, but some instances, we may be selling down 25% of the portfolio per annum because we're looking for the returns. Wine doesn't go up in a linear fashion. Drinking windows, rescores, all come into play. So, for example, there may be a rescore coming up in a year. We expect, from our knowledge of the market, the wine to get rescored higher, and therefore the price of that wine to increase. So we'll buy that wine at such point before the rescore, and then the rescore comes. If we're correct, the wine goes up, and then we sell the wine. So it depends on the client in question. But I would say on average, probably 15 to 20% of the portfolio would be sold down per year.
That's very similar to us, actually. That's what we call a portfolio turnover. There is a question from Jogos to you guys. I think reselling a portfolio, part of that, is it are the profits subject to taxation being treated like capital gains? For us, it's bluntly yes. But in terms of wine, Marcus?
No, so you could get into the technicalities of this, and obviously I'd always say speak to a tax advisor, but the rules stipulate that as a wasting chattel, this wine hasn't got a shelf life of over 50 years. Now, some of these wines may have a shelf life of over 50 years, may go on for many generations. As I mentioned earlier, the 1945 was the most expensive bottle of wine ever sold. But you're talking about the 50-year rule when you buy that wine. So if I'm buying in 1985 now, is it going to have a 50-year life cycle? Most likely not. Is a 2019 going to have 50 years? Well, I can't give you that answer. So really, you just got to accept that it's capital gains tax exempt in most cases, and we haven't ever seen an issue with that.
Great. And there's one question from James to say that I don't see pension under the investable asset section in this basic example. Is that intentional? No, it's not. Of course, we let you put in anything that you consider as part of your investable assets into that. And you're right, pension definitely should be part of that. It's just that our example didn't include that, of that client. And we can also open the Rosecut ISA for you in just a couple of days' time. So pension wrapper is on our roadmap, but it will happen in about 6 months' time. But that doesn't impact you having a holistic view of all your assets, and you can list them all on your Rosecut wealth balance sheet.
And just on pensions in fine wine, so unfortunately in the UK, you can't invest in wine in a pension, so it's not SIP allowable. However, you can invest in a QNUPS, so if you've got a qualified overseas pension, or if you happen to be an Australian investor, a self-managed superannuation fund allows investment from pensions as well. So it's different in different parts of the world. In the UK, unfortunately, you cannot. I've got a question here, which is quite quick and easy to answer. How long would it take to liquidate a £100,000 portfolio? If it was a regular, if it's £100,000 that someone had invested with us and that's all they've got with us, then that's going to be in pretty vanilla positions, and it would take us 8 weeks, 6 to 8 weeks to do that. If it was £100,000 of a £1 million portfolio, for example, where they were invested in a wider array of wines and some rarer stock, it could take 8 to 12 weeks.
So I would say that's actually relatively slightly more liquid type of illiquid assets, because typically it would take you longer to sell a piece of diamond or a piece of antique or your property in London. And this shows, why you should have both. For the financial assets, it takes us a T plus 3 days to liquidate a portfolio, and typically from the request to the money back into your account, that's definitely within a week, because we don't invest into anything illiquid.
Yeah. If you need your cash back quickly, you call Qiaojia, you don't call me.
All right.
Next question that I had was, if you have an existing wine collection in bond, can Cole Wines manage that for me? And the answer is absolutely. So, just like any other investment company, we can take on those assets and we can manage those assets for the client. So we would, providing that they're all in bond, we will go and monitor and check those assets, provide they are exactly as they're said. We can take them on into our bond warehouse facility and then manage those assets as part of a wider portfolio just for the client. And quite a lot of people that we speak to have got wines elsewhere, and they like the fact that they can all come under one roof. And actually the image that I showed of our online platform, you've actually got a section for wines held elsewhere. So yeah, absolutely, we can do that. Got another question. How is the market for fine wine affected by interest rates being lower for longer? I think the fact is, with a low interest rate environment, this is what really over the last 15 years has pushed people into investing into other assets like alternatives, because they're looking for a hunt for yield. So, the more time, the longer it goes on with people not getting money in the bank, I think the more that will be made in alternatives, not just wine, but other assets as well.
I would echo that. I would say that, not holding cash is probably the worst thing for, relatively compared to other period of time, because one, you have a very low interest rate and negative interest rate in a lot of countries around the world. And second, given the recent government measures, there is much more liquidity. There's a lot of liquidity in the market already, and that effect is longer lasting than people expected, as evidenced by the last financial crisis in 2008. So actually putting your cash to work is important. It's beyond having your emergency cash. It's never prudent to put every penny into investment, but equally, it's really not helping you by holding most of your assets in cash. it can be counterintuitive to invest at the moment because you fear, the wider environment. But it's rather not to sort of follow the trend when it's halfway through the boom and bust cycle, but to really go in when most people are fearful. Remember the saying from Buffett is that you get greedy when people are fearful and fearful when people are greedy. So there is sort of contrarian view that people need to start to get used to in terms of investing and never, behave like herd and follow the wider markets. And equally, relying on professional ideas, professional guidance is super important. We have seen a recent trend of people diving into the online trading platforms without, the knowledge of what actually they are doing, especially before venturing into, leveraged trading like, futures and options. And those are just, automated weapons that can wipe out your money at a much quicker speed. So, I think to conclude, Fine Wine and Rosecut both provide one-stop, investment service to look after a pot of your money that you don't have to pick a single investment. You can just, agree with us on a risk level and sort of the purpose of this investment and, the time horizon and your preference and such. And we both have, a proper risk assessment to guide you through to ensure that we are aligned in terms of how we are going to manage this money for you, and all you need to do is to work out your asset allocation plan and allocate your funds accordingly.
I've just got two final questions, and actually looks like we'll finish bang on 1:15. So you're absolutely right. The first one is, what are the costs involved, storage, insurance, and brokerage fees? Very simple, 2% per annum is the fee that we charge our clients for storage, insurance, brokerage, and managed and earn a managed account. So if you were to go and buy, thank you, you got it on the screen there. If you were to go and buy wine from a merchant, first and foremost, you're paying a merchant's margin, a spread. They buy wine for X, sell it for Y. That's how they make their money. With us, you're buying at the investment market value. So we don't add any spread or margin on our wine because our clients are investors. We charge them a management fee. So that annual fee is 2% per year. And that covers everything. If you were to go on your own and try and store and insure wine, it could even cost you 2% per year without any additional fees. And brokerage is 10%. If you went to a merchant to sell wine, it's about 10%. So 2% per annum is the best in the market. Acquisitions and operations fee is more like an access fee. It's not like equities. There are lots of fees associated in this market, in a physical asset, shipping, handling, logistics, etc. And our fee is to access these wines. So we know a portfolio of wines for these investors is very hard to get hold of at these prices. So for tier 3 investors, from 25k up to 250k, they pay a 5% setup fee, and then you can see tier 2, 2.5, and tier 1, 0. So that's not tier 2. An investor investing $1 million on day one pays 0% on their entire portfolio for setup. The next question is, who are the typical buyers for those wines? So typical buyers for us, we sell to wholesalers, merchants all over the world. So to our investors, we are a private bank for fine wine, you could say. They're asset manager for fine wine. But to other wholesalers and merchants on the street, we're just another wholesaler, broker, or merchant, because to them, we're just selling wines into that network. The difference is we're selling our clients' wines when they're exiting the market. So client Y wants to sell out of his portfolio. Instantly, that stock gets uploaded onto our system, and every day those price lists go out to the merchants, and they may come back and say, okay, I want to buy your 20 cases of Pape Clement at X price, and we'll transact that on behalf of the client. So that's all done and dusted as part of our fees. And that's the answer to those two questions.
Great. I think that's all the attendees' question answered, actually. We've done better than last time. Last time we left many unanswered due to running out of time. But, rest assured, if you have any other questions, feel free to get in touch with us. And here are the emails. And if we will be, editing and, putting this videos through compliance. And after that, we will be posting on the Rosecut website. And, Marcus, your company is free to share that as well. So I would like to thank everyone for attending and spending the last an hour and 16 minutes with us.
Thank you for having me. Thank you very much. And I'd say the same thing. We'd love to see you all for a glass of wine when this is all over. So thank you.
Yeah, we could start investing now and enjoying the wine as a celebration towards the end. And thank you, Marcus, for having a really interesting discussion with me. And we can say we can see you around for the next event.
Thank you. Thanks, guys.
Thanks, everyone. Bye for now.
Bye.